think a lot of people don't realize that muni bonds are always tax-free. Well, not necessarily. If you buy it at one price and sell it for a greater price or lower price, there's a capital gain or capital loss.
Now, you ready for some municipal bond action?
Okay, I guess so.
Okay, he's got 3 questions. They're quite lengthy. Number 1, given we don't have the need for current income, we are thinking about buying zero coupon bonds so that the interest can accrue and we collect the full amount only at maturity. Timed used a 10-year bond ladder, so 1/10 of them mature each year, with the first rung to mature when we are age 65. However, I'm concerned about the de minimis rules on deeply discounted muni bonds. Does that rule apply to zero coupon muni bonds? And if so, how do you calculate it for the zero coupon bond? Oh boy. Is that a rule? Good reason for individual investors to totally ignore bonds that are penalized under this rule. All right. So he's talking zero coupon de minimis.
Yeah. So first of all, let me explain what the de minimis rule is. And that's if you buy a bond at a discount, and if it's too big of a discount, by the time it matures, you're going to have an ordinary income part, right? For the
discounted, the deeper discount?
Yeah, the deeper discount. And if it's below a certain threshold, it's a capital gain. So that's what this is. And the threshold is 1/4% times the number of years the bond is. Like for example, like let's say you've got a 10-year bond, right? Times 0.25 is 2.5%. So in other words, if the bond discount was less than 2.5%, then you've got a capital gain when either you sell, right, or it gets redeemed. Otherwise, if it's more than that, even if it's $1 more than that, the whole thing is ordinary income at the time of redemption.
So let's talk about discount for a second, because I think a lot of people, including myself, are a little confused.
Right.
So let's say a bond is issued at par, right? So $1,000.
Right.
And so they issue it at par, $1,000. I pay $1,000. Now I lent my money to the organization. In return, I'm going to receive an interest rate. Let's just say 5%.
Right.
So I'm receiving $5 of interest on that $1,000 loan, right? In a zero coupon bond, what Jimmy wants to do is like, he doesn't want to get that 5% per year. He wants to say, you know what, just pay me at the end because I don't need the income now, but I'm going to buy the bond. And when it matures, I'm going to accrue all of the interest. And because of the way that bond is structured, I'm guessing there's a deeper discount on the zero coupon bond in the municipal bond market. So he's wondering, well, is it going to pay out because I'm buying it at such a deep discount? So I'm not buying it at $1,000. I'm buying it at $700.
Right.
And it's still going to pay me that 5% interest, but I'm going to get the $300, plus the 5% interest when it matures in 10 years from now.
Yeah, that's accurate. Well, first of all, 5% of $1,000 is $50.
I'm sorry.
So you said 5. So just for our listeners, $50 is your income.
Thank you.
But if you buy it when it's issued, there's no problem. It's at par. It's only when you buy it in the secondary market. It could be a discount, or there could be a premium, depending upon if the interest rate's gone up or gone down. And it hasn't been much of a problem lately because interest rates have been going down. But when interest rates go up, now it's like, I got to discount my bond because the interest rate's too low compared to what you could get in the primary market, right? So you've got to discount the bond to do it. So we're going to see more of this. Now, zero coupon bonds are a different animal, just like you described. You basically just buy a $10,000 bond for $5,000 or whatever it is, and at the end of the term, you get the full $10,000 back. So the nice thing about a muni zero coupon bond is it's not taxable, right? Because it's tax-free. So these rules, the de minimis rule doesn't really apply
to the interest.
To the interest part, which is all of it, right? Unless you buy it in the secondary market, then there might be a little bit of that. And then you've got to determine, is there a premium or discount? If there's a discount, you might run into this rule. But I think by and large, Jimmy, it's not that big of a deal because even if there's a little bit, in other words, it's not the the entire discount that's subject to this rule. It's just that what you paid for it in the secondary market versus kind of what the real true market
what the
value,
par would be.
what the par would be. Better way to say it. Yep.
So the discount part of it is going to be subject to ordinary income or capital gains.
Right.
The interest is still tax free. So if you buy like a municipal bond mutual fund, and you buy that mutual fund at $100,000 and it's worth $150,000 and you never sold it, but you received tax-free income from it,
Yeah.
and you decide to sell the mutual fund, you're still going to have a capital gain on the $50,000 of gain.
Yeah, well, that's right. I think a lot of people don't realize that muni bonds are always tax-free. Well, not necessarily. If you buy it at one price and sell it for a greater price or lower price, there's a capital gain or capital loss, which actually could be even ordinary if you don't meet the de minimis rule.
Did we answer 2 and 3 during this little conversation? I didn't read any of this stuff.
No, I don't think so.
Okay, let's go. We do not plan on collecting Social Security until age 70. Our annual expenses is $100,000 a year. Therefore, we expect once we retire in 10 years, our annual portfolio withdrawal will be about $120,000 a year pre-tax. Currently, 40% of our portfolio is Roth, 30% is a brokerage account, 30% is a 401k. So the pre-age 70 distribution can be managed quite tax efficiently. Given our post-retirement tax rates could be very low, would zero coupon muni bonds that mature in 10 years still be a good idea? A related question, if we do buy muni bonds that are subject to de minimis rules, is that ordinary tax treatment applied each year we hold the bond or only at maturity? If it's the latter, and we plan to hold the muni bonds until maturity when our tax rates are low, should we even care about this?
All right. De minimis rule is only when you sell or you redeem. So you don't have to worry about it ongoing.
So, and then if his tax rates are pretty low,
doesn't matter.
Don't matter.
In fact, if he buys it on issuance and holds it to redemption, there's no gain, right? Except for if you bought it at a discount, but you wouldn't have that if you buy an original issue.
I'm sure he's buying on the market.
I would think so.
Given we are planning to stay in California after retirement, we should only focus on California municipal bonds. Well, yeah, if you want the state tax free.
Right.
Federal, you could buy a municipal bond in Texas. You're going to get federal tax free, but you're going to have to pay the franchise tax board.
Correct.
Okay. All right. We answered all of Jimmy's questions on de minimis. Hopefully that was not as de minimis as it sounded.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.